let's continue with that depreciation. What if we have a partial year? We don't buy assets on January 1st and dispose of them on December 31st, right? Nobody cares about that. Things are happening all year long. So if you have a partial year depreciation, then we have to calculate that. So let's look at this. We bought office equipment on September 30th, 2015. So we bought it September 30th. And if we have a calendar year end, which apparently we do with December 31st, we need to depreciate that asset for October, November, and December. 3 months, partial year. So what we do is we calculate what a full year's depreciation would be, and then we just take 3 months of that. So here we go. We've got all the information here, 68.5, useful life 15 years, residual value $5,500. So let's figure out what regular depreciation would be. Oh, there you go, 3 months. 68.5, right? Cost minus residual value divided by the useful life of the asset, 15 years. So 1 full year's worth of depreciation would be $4,200, but it's not 1 year. It's only 3 months. So 4,200, well, I take it into 2 steps here. 4,200 divided by 12 gives you the monthly amount. For 3 months times 3 would be 1,050. Really, you could just take 4,200 times 3/12 to give you 3 months of the year, and that would work too. I just kind of did it in 2 steps. So the depreciation for those 3 months as of December 31st is just 1,050, and there's your regular journal entry. Debit depreciation expense, credit accumulated depreciation for 1,050. So, like I said, it's a partial year. You calculate the full year's depreciation, and you take whatever portion it is. Okay. All right, moving on to the next one, units of production. A little bit hairier to calculate. It's not quite as easy as straight line, and if you notice, it's not straight line, right? It goes up, it goes down. It depends on how much you use the asset. So really, this one's a little bit more specific, and it's a probably more accurate calculation. What kind of assets would this make sense for? Well, something like a car. If you drive the car for, you have a car in your business and you drive it for 20,000 miles, and then the next year you'd only drive it for 2,000 miles, well, then logic says you should have it more depreciation in the year that you drove it for 20,000 miles, no? So the idea here is that depending on how much you use the asset is how much you're going to depreciate it. So that's a lot more logical, right? But it's more work. Okay, so let's look at this. We have the same basic setup here. We're going to take it into 2 steps, though. Step 1, we're going to calculate a rate. And step 2, whoops, I got to move myself again. Step 2, we're going to apply the rate to calculate the depreciation. You'll see as we go through. All right, so take a look at this calculation here. It's the same numerator, it's the same depreciable base, cost minus residual value, but the denominator now is not based on time, it's the useful life in units. So if this was like a car, it'd be how many miles do we plan on driving the car over its entire lifetime with us? 100,000, 50,000, right? That would be that denominator there. In this case, we're looking at a piece of equipment, and we're saying that the equipment is going to produce 10,000 units. Right? Because equipment is, think manufacturing. It's going to put out 10,000 units of something. All right, so here we go. We're going to throw those in there, same numerator, and over 10,000 units. This is the part where I say we calculate a rate. The rate is, oops, too far, $1.50 per unit. So for every unit that this thing produces, this piece of equipment produces, we're going to depreciate it for $1.50. All right, that's the rate. All right, so let's draw our T counts because I like those. You got your equipment and your accumulated depreciation. The equipment's 17,000. We got to figure out depreciation in year 1. Well, year 1 we produce 1,000 units with this machine. So we take 1,000 units times the rate, $1.50 a unit, and that comes out to $1,500. $1,500 is my depreciation this year. The net book value at this point is the 17,000 minus 1,500 is 15,500. All right, so year 2 comes along. We produce 3,000 units. Well, we use this thing a lot more in the second year. So if that's the case, we take 3,000 units times $1.50 a unit, right? There's the rate, $4,500. So there's your 4,500 that goes here. The book value at this point is 17,000 minus the 6,000 we've got here in accumulated depreciation, so it's 11,000. Okay, year 3 comes along, 0 units produced. For whatever reason, we didn't even use the piece of equipment. Okay, If that's the case, guess what? No depreciation. If I don't use it, it doesn't depreciate. Whereas straight line, you would still depreciate exactly the same amount. So like I said, this is a little bit more specific. And your book value doesn't change because your depreciation didn't change. All right. There you go. There's your, 11,000 net book value there. All right. I hope that makes sense. Let's go on to double decline balance. This is the one for job security. I think I can put myself back up in the corner. There you go. Because double decline balance is a pain, but it is a valid depreciation calculation. And what it does is it puts the depreciation at the beginning of the asset's life and less at the end. Which you may think, well, that makes sense because don't we hear all the time that as soon as you drive a car off a lot, it loses, a ton of value right away? Yeah. All right. So that's why this is kind of good for those situations. You buy something and you lose a lot of depreciation at the beginning. Well, also, the good thing about this is it pushes the expenses up high, which means your net income is lower, which means you pay less taxes. One of the reasons why this maintains its popularity is because it actually is pretty much the same way the IRS does depreciation. There's a few more nuances for the IRS, but what they use is they do something called MACRS, which is Modified Accelerated Cost Recovery System. No worries, I'm not making you memorize that. But the IRS does the same thing. It puts all the depreciation at the beginning of the asset's life and less at the end. The IRS wants you to do well, right? Because the better you do, the better they do. The better the country does, right? The more money your business makes, the better for everybody. So the idea is that they make all the expenses be in the beginning because they want you to be able to keep your money in-house and not have to pay a ton of taxes. So then by the time a few years has passed and your expenses are really low and your net income is much higher, you have the ability to pay the taxes. So it's not a bad thing. All right. Double declining balance. It's kind of like straight line times 2, but that's not totally accurate. I don't want you to calculate straight line and then multiply by 2. That's not how that works, but it is kind of, right? That's where it's double declining balance. It's kind of like straight line times 2. Let me show you what I mean. You're going to come out with a rate on this one as well. Now the idea is you're figuring out the straight line rate first. Well, the straight line rate is 5 years. That means 1/5 every year, 20%. So if that's the case, 1/5 every year is 20%, right? That's straight line. 1/5, 1/5, 1/5, 1/5, 1/5. It's straight line times 2. So instead of 20%, our depreciation rate is going to be 40%. If you didn't understand that, rewind me and try to listen again. But the other chance that you have to look at these, the way I kind of tell my students that they can kind of cheat the system here, is you can just put 2 over the number of years of the asset's life. So you put a number 2 over 5, and I can't write on here, it won't let me. Put 2 over the number of years. So 2/5 is 40%, and that's how you come up with it. If it was 10 years, it'd be 2 over 10 years, 20%. Right? So the idea is you can kind of cheat and you don't have to do the big calculation. You can just do 2 over, you know what, I want to write it. Hang on. It's not going to be pretty, but I'm going to write it. So you can just put 2 over the number of years. Not the worst, not the best, but not the worst. Okay. So one thing with this one, we start off with this table. It's just easier to see that way. The beginning book value. You don't subtract the residual value from the beginning. You just start off straight off with the full amount. 17,000 is the only one that starts that way. Oh, look at that. I did it. 2 over useful life in years. I did give that note. Okay, so 17,000 is going to go in here. The depreciation rate we just said is 40%. So you're going to multiply these two, and your depreciation expense in year 1 is going to be $6,800. The accumulated depreciation is going to be $6,800 because it's year 1. And the ending book value then is the 17,000 it was worth minus the 6,800 is 10,200. Okay? Let's take it on to the next year. Year 2. Well, this is where it's interesting. Year 2 actually starts with, I should have left my arrow on, my pen on. Year 2 starts with the ending book value for the calculation. So this 10,200 is actually coming here. 10,200 times 40%, right? You're always starting with the book value. 10,200 times 40% is 4,080. So now accumulated depreciation is 6,800 plus the 4,880, right? Add these two guys together. And you're at 10,880. So my ending book value now is, it was $17,000 worth to me originally, minus the $10,880. We're at $6,120. Okay, we're going to take that $6,120. We're going to come over here, 40%. We're going to do the same math. $2,448. My accumulated depreciation, $10,880 plus $2,448 is going to be $13,328. So now the beginning value, $17,000 minus $13,328. There's $36,72. Two more. Okay, so we're going to take this $36.72. I may as well stay consistent, draw another arrow. 40%, $14.69, $14,797 accumulated depreciation. My ending book value is, well, I'll draw the line again. $13,328 plus $14.69. My ending book value is $22.03. Now, before we go any further, we can't depreciate past the residual value. That's a rule. So we can't, our ending book value has to be 2,000. It has to be. So that's one of the quirks with double decline balance. It has to be the residual value, it has to be the ending value. If I were to just take 2203 times 40% and do the same thing I've been doing, guess what? It's going to push me past lower than 2,000. So in the last year on these, you're going to plug the number to make it work. So if you see the book value is 2203 and I want it to be 2,000, that means my number is going to be 203 of depreciation. So last year requires a little bit of a plug. So now my beginning book value is 17,000, my accumulated depreciation is 15. That leaves me with a residual value of 2, and that's what I want. Okay? We force it in that last year to be what we want it to be. Oh, too far. I hope you got that. Okay.